Welcome back to the Internal Auditor, where we dive deep into the world of internal auditing, corporate governance, and fraud prevention. Today, we're exploring some of the most infamous internal audit failures in corporate history. We'll discuss what went wrong, why it happened, and how internal auditors can prevent such disasters in the future. But that's not all. We'll also look at the legal steps governments took to prevent these incidents from happening again. First up, the Enron scandal, one of the most high-profile cases of corporate misconduct. Enron's collapse in 2001 wasn't just a corporate failure. It was a massive audit failure by Arthur Andersen, one of the then Big Five accounting firms. Arthur Andersen was heavily criticized for failing to detect fraudulent financial reporting. The key issues here were a lack of auditor independence, ineffective whistleblower protection, and insufficient regulatory oversight. To ensure compliance and avert such scandals, auditors must maintain independence, both in fact and appearance. Organizations should enforce strong whistleblower protections to encourage reporting of irregularities. Finally, regulatory bodies need to hold auditors accountable to prevent future frauds. So, what did the government do to prevent another Enron? Enter the Sarbanes-Oxley Act of 2002, also known as SOX. This landmark legislation increased corporate accountability by enhancing financial disclosures and combating corporate fraud. It established the Public Company Accounting Oversight Board (PCAB) to oversee audits of public companies. Next, we have Toshiba. In 2015, an internal audit failure led to a scandal where the company was found to have inflated earnings by $1.2 billion over 5 years. Despite a sound governance structure on paper, the practical implementation was lacking. This case highlights the importance of proactive internal auditing. Auditors need to go beyond just compliance and ensure that governance structures are effectively implemented. In response to such scandals, Japan's Financial Instruments and Exchange Act was revised to strengthen corporate governance and increase penalties for financial misconduct. For internal auditors, it's crucial to conduct regular in-depth audits and not just rely on surface-level checks. Additionally, comprehensive risk assessments should be integrated into the auditing process to identify potential areas of fraud before they escalate. Thirdly, even giants like Ernst Young aren't immune. In 2016, EY was fined $11.8 million by the SEC for failing to detect fraudulent activities over 4 consecutive years. They also failed to address recurring tax-related issues. This underscores the critical role of auditors in scrutinizing high-risk areas and addressing known deficiencies proactively. The SEC's actions in this case remind us of the importance of regulatory enforcement. The Sarbanes-Oxley Act also played a role here, reinforcing the necessity for stringent auditing standards and corporate accountability. For internal auditors, they must prioritize high-risk areas and ensure thorough, diligent auditing practices. Implementing advanced data analytics tools can also enhance the detection of anomalies and fraudulent activities. Lastly, we have Worldcom, another colossal audit failure involving Arthur Andersen. The auditors failed to detect a massive accounting fraud, leading to one of the largest bankruptcies in U.S. history. This case illustrates the need for vigilance and skepticism in auditing. Auditors have a moral and ethical duty to report financial irregularities. Following Worldcom, the Sarbanes-Oxley Act further strengthened corporate governance and increased penalties for fraudulent financial activities. For internal auditors, they must exercise skepticism and adhere to ethical standards, ensuring they report any financial irregularities they uncover. Utilizing fraud detection mechanisms, such as forensic accounting techniques, can significantly bolster the effectiveness of audits. So, what can we learn from these cases? Internal auditors play a crucial role in ensuring corporate accountability. By maintaining independence, being proactive, focusing on high-risk areas, and adhering to ethical standards, auditors can prevent such scandals. Governments have taken significant legal steps, like the Sarbanes-Oxley Act and Japan's Financial Instruments and Exchange Act, to prevent future incidents. These laws enhance oversight and impose stricter penalties for corporate misconduct. Thank you for watching. Don't forget to like, subscribe, and hit the bell icon for more insights into internal auditing and corporate governance. Leave your thoughts in the comments below. Until next time, stay vigilant and keep auditing.